A very good evening and welcome. You're watching the India Development Debate with me, Tamanna Inamdar. After almost a year of drought, last week Zepto raised $200 million at a valuation of $1.4 billion to become India's first unicorn of 2023. Is this a turnaround in the startup space is the question. Some decent news has come up for this space in the recent past. Zomato turned profitable after 15 years, so did Meesho's, and startups are seeing some funding turnaround and raised interest. However, it might be a little early to say all is well. Now, on the positive front, Capital marked up valuation of Swiggy and Pine Lab. The same agency, though, has halved the valuation of Byju's. So what really is going on? Is this the end or the beginning of the end of a terrible funding winter for the startup space? Is it reflecting where India's economy is going, or is there more pain left? We're going to be talking about all of that, but let me begin with this report from my colleague Sharath.
Well, yes, a very important news coming for the startups, and we always knew about the funding winter. A lot of valuation corrections, markdowns, and a lot of negative news coming in the startup space. But now there is a sliver of hope. The first unicorn of 2023, which is Zepto, has come up, and of course they have raised $200 million in their round of funding. But the important thing is the valuation comes in at almost $1.4 billion. That makes it the first unicorn of this year. Also, this is a very important moment for the Indian startup ecosystem also, as most of the startups are actually focusing on their path to profitability. Now, looking at the details of the funding, the fundraise was done by Stepstone Group as well as Goodwater Capital, as well as the existing investors like Nexus, Gladebrook Capital participated in it. Now, of course, in 2022, they had raised $200 million, but the valuation was $100 million short of becoming a unicorn. But now the drought of unicorn is over, and Zepto is becoming the first unicorn of 2023. Now the company itself going ahead is eyeing a public offering also over the next 2 to 3 years, and important triggers going ahead include the primary use of investment of funds in growth as well as expansion of the value-added offerings such as Zepto Cafe as well. Now in terms of the profitability, they are targeting the EBITDA profitability between 12 to 15 odd months, and they also plan to invest. They're increasing the presence in their existing markets. But overall, the biggest news in the startup space is Zepto has become the first unicorn of this year.
And it couldn't have been later. We're already in September, and that's when the first unicorn has come in of 2023. But is this a sign that things are getting better is the question. K Ganesh, serial entrepreneur, is with me on the show today. I'm speaking with Siddharth Pai, founding partner at 314 Capital, and Nimish Trivedi, CEO of Evera Cabs. Welcome to all of you, and thank you so much for joining us today on the show. Mr. Ganesh, let me begin with your take. Are we celebrating too early? Or is there at least a return to some sort of optimism?
Yeah, firstly, the headline news that catches the attention is good news.
Yeah.
So that's better than all the layoffs and down rounds and valuation and corporate governance issues that we have been continuously being badgered with in the media. And of course, media is reflecting what's happening. So that headline news is good. But if you look at it in reality, firstly, what's happening is that venture capitalists, private equity have been sitting on funds that they have raised. They have not been deploying for quite some time. One reason is the uncertainty of valuations. Nobody wants to catch a falling knife. They want to see how low it will go before they're investing. So there has been a certain level of paralysis or inaction in the investment space. Now that is getting opened up because they can't keep on sitting. They have raised money for risk capital. They can't deploy it in the bank. They can't not do the call down. So that is what you're seeing now. Obviously, the valuation of Zepto is staggering. It's very nice. It's very good news. Otherwise, we have heard funding only from internal investors, typically at flat rounds or down rounds. But beyond that, I don't want to read too much into this, because even the valuation markdowns in the past were really some investor, one investor, two investor writing down the valuation of their investment sitting somewhere in US or Europe. That did not reflect the reality. Okay, right? So therefore, I was not very concerned about it. Therefore, I'm not very euphoric about this now also. But the fundamentals have really changed. What I'm very bullish and what I like is the fact that the companies, whether they are publicly listed companies, which are new age tech IPOs that are now gone up from their lows that were there in the past and have crossed their IPO listing price and all of that, that is very good news. These are huge platforms. The transaction volumes are increasing. Their market shares are increasing. They are moving towards profitability. And several other environmental factors like the digital public infrastructure, whether it's the ocean networks, whether ONDC, all of this are signaling a very, very strong future for new age companies, whether private or public. So that I'm very, very bullish about.
So the funding winter that we've been talking about has not just been because of local factors. It's also been global factors playing through. So we need to look at it in that context as well. And it also seems very specific, not generic. For example, Baron Capital marked up Swiggy and Pine Labs in June, but that was not the same idea for Byju, whose valuations were halved. Siddharth Pai, you know, there was a time when the waves saw all boats float when it came to the startup space. There was so much exciting that everything was getting great valuations. Do you think it's become tougher now? You know, the valuations have become more picky and it is more merit-based.
It's actually become a buyer's market as of now. What we saw, especially in the end of 2020 as well as in 2021, the fear of missing out ended up actually dictating the investment patterns of a number of investors, where most of their thesis building was supposed to be grounds up. Some thesis building was also very top down. There are certain types of business or business models that would end up benefiting from the pandemic. Let's actually load in as much money as we actually can into those into any of the assets that are under those particular classes. We also saw a large number of crypto companies end up actually raising large amount of funding. And unfortunately, when the tide actually turned, a large amount of money ended up actually getting receded back. Now, this is, like you said, because of macro factors, because everyone's looking for a flight to safety, and fixed income securities, either by governments or anyone for that matter, now become the mainstay of a number of investors itself. But I think that being said, there are still a number of investors who are actually looking at these particular assets on a risk-adjusted basis. They don't mind actually putting money behind that. I think Zepto is a prime example of that, wherein because we've actually seen some of the competitors end up unfortunately facing sort of headwinds, it did actually support the kind of raise that Zepto is actually looking. And with the large amount of money they have in the bank now, they can actually consolidate and build upon their position and make use of some of the issues that their competitors are unfortunately facing. So I think, like Ganesh actually said, there is a large amount of capital that's actually waiting to come. I think it's just a question of the person actually making the first investment. The one thing we're also seeing now, Tamanna, which is also important, a number of founders have realized that easy capital is no longer available, and they're looking to make their companies more profitable. And there are a large number of investors looking at this very, very keenly. So when the companies are on a path to profitability, they end up actually becoming EBITDA positive, or they can end up becoming PAT positive soon. Most investors want to preempt a round over there, end up putting that. So I do foresee during the course of this year and sometime early next year, despite the elections, we should end up seeing a few large rounds end up actually happening over the year itself. It may not be all the companies that got funded over the last 18 to 24 months, but the best of the best are actually coming out. Will continue to attract capital, and investors are very hungry to end up getting a piece of these particular well-performing companies as well.
Will these top companies be rigid and stick on to their 2021 valuations? That seems to be a concern, that the top companies are not ready to, you know, sort of re-evaluate looking at the new realities. Are we being too picky? That's a question, of course, we need to answer as well. But let me come to Nimish Trivedi from, a first-hand sort of point of view. Mr. Trivedi, do you see the purse strings loosening again? I mean, would it be too early to say that the funding winter is over, or are we just seeing the first signs of spring?
I think, yeah, you're right in a way. It's just first sign of spring, and we've got to be positive about the way the news are coming in. Despite seeing a sharp drop for close to about 70% in the investments that were made over the previous year, with the wave now getting onto a normalization, I guess a very imperative point here, what Siddharth just made, was about the startups having a very conscious approach towards profitability, number one, and to display resilience, have a large adaptability, and innovation is the key probably, which will change the entire narrative. Because ultimately, it is how we can probably innovate and give a better product into the market for the investors to really piggy ride and make their own money out of it. At end of the day, investors have to make money, and that's probably the most conscious approach that every startup in India will have to look at.
So there is hope over there. Mr. Ganesh, let me come to the question of valuation, especially for the top, companies out there, and this sense that Indian startups are unwilling to lower expectations, are stuck to 2021 valuations, at least the top ones, the ones who think that they can afford to. Do you think that will change?
I think it has definitely already changed because valuation is a function of demand and supply. During euphoric times, entrepreneurs were lucky, founders were lucky, companies raised money at high valuation because that demand supply equation dictated it. Already people are reconciled to the fact that those valuations are gone. In a public market, it gets automatically determined. In a private market, the founders and the existing investors have to adjust to the reality. There is no really choice. What I find it surprising and what is really harmful is when people start trying to, for optical reasons, for ego reasons, start defending that valuations by having structured financing, wherein they give certain protections, certain rights to investors so that optically that valuation is maintained. I don't want to name companies, but many of the companies that raised money on flat rounds, actually it's not really flat round, it's a down round, but optically in order to show they have done that. Better to take a hit, apply the anti-dilution. During the boom times, you enjoy phenomenal valuations and take benefit of it. During tough times, if you need the money, just do a simple structure, take a down round, apply anti-dilution. Anyway, it doesn't affect too much because you have a weighted average formula for anti-dilution. Just go ahead with it. That realization already exists. I think that's what will happen. And for some time, it will come like this. Again, euphoria will start. Again, we will see high valuations. These cycles I have seen multiple times, and that's part of reality. I think people are very well aware of it.
I want you to sort of weigh in on this, Siddharth, on whether our ecosystem is being overly optimistic, is reality striking in, sinking in, and is it a good idea to go with the flow right now and downfund if you need to?
I think if a founder or a promoter is actually given the choice between sticking on to a vanity valuation given 18, 24 months ago versus actually biting the bullet and getting the money and capital they need to run their business, I don't see a single founder holding on to that particular valuation itself. I think most of the conversations that have happened across boardrooms and in discussion with founders and investors, everyone's very clear and certain about one thing, is that the business should continue. If the business does actually have legs for that matter, they should end up continuing cutting costs, rationalizing, looking to become leaner and more efficient. Whatever valuation they may end up losing in the interim as of now is something if the company does well, they can end up actually gaining in the past. So I think the reconciliation has actually come through. There are a number of promoters are still optimistic and still hope to end up actually building out a leaner business with the cash balances that they have. But I think as the cash ends up actually reducing in most of their balance sheets, they will end up being forced to go out to the market itself and end up actually raising. But Tamanna, a very important point over here to also note is that similar to the cash constraints that founders and startups end up having, investors have a similar cash constraint as well. We've actually seen the highest volume of capital raised for India-focused funds over the last 18 months itself. This is when we've seen the greatest downfall in terms of the capital raised by Indian startups. Now that money and those capital commitments are actually burning a hole in the pockets of investors. Most of these investors are also feeling that particular burn, and they're looking for quality assets to end up doing it. So I think given these market forces at play, where a company may end up needing to raise cash, and there are some investors who also need to end up deploying as per their fund documents in case if they fail to deploy, they may not be able to raise a subsequent fund in the near future. We'll end up seeing some sort of meat in the middle that ends up actually happening over there. I don't think the high watermark for previous valuations is the benchmark anyone's keeping. Founders may hope to end up actually retaining that valuation, but if the choice between vanity as well as survival will always end up trumping that.
So survival is key at this point. Nimish Trivedi, what would be your take on this? Survival is key. It's okay to let go of, and I like that term Siddharth Pai mentioned, vanity valuations.
No, I fairly agree with that point. Yes, that survival is surely the key here because you can take a beating for a moment and probably make some good valuations when the markets are performing better. So it is surely cyclic process where at what time you enter into the process is where you really see. But at the end of the day, I would again insist that it's all about how really startups consciously work towards having a fair understanding about how they can at least reach to a profitable number as quickly as possible. And with that focus around, I'm sure everyone in the process is happy. The investors are happy, the customers are happy, and the startup is also happy. So in the Indian startup landscape, I believe that's the new change and resetting of the fundamentals that's happening, which is a kind of a welcome situation, so to say.
So, no celebrations or announcements of the funding winter having ended so far, but the first few signs are positive. We'll have to wait and see if that momentum remains and sustains. Thank you so much to all of you for joining us on the show this evening. I'm going to take a very short break, but stay tuned. A lot more coming up on the other side.